We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell.
My guests in this episode of the Exceptional Advisor podcast are Sid Muralidhar, founder of RiskStyle and the Chief Executive Officer of Commodity Investing by Students at Virginia Tech, from which Sid just graduated, and Arun Muralidhar, co-founder of M-Cube Investment Technologies and Client Chief Investment Officer of Alpha Engine Global Investment Solutions. Arun and Sid are the 2021 recipients of the Investments and Wealth Journal Research Award. That award honors Edward D. Baker III, the first editor of the Journal of Investment Consulting. The Journal Research Award honors the authors of an original paper that represents the best writing for the previous year germane to the investment management consulting and/or private wealth management professions. By way of background, each paper published in the Journal of Investment Consulting and Retirement Management Journal is considered for this award, and each paper is evaluated by judges for its academic and analytical vision and originality of research. In today's episode, we'll discuss Sid and Arun's award-winning paper, Behavioral Finance in Investing, the Existence and Importance of Investment Tribes and Risk Preference Diversity. And I should note before we get started that Sid and Arun are the first ever father-son team to win the Journal Research Award. Sid, Arun, welcome to the podcast. So welcome to the podcast, Arun and Sid.
Thank you. Thank you for having
us.
Thanks,
Bob. We really appreciate it.
Oh, it's a pleasure to have you here. And I'm wondering if we could start by having you each tell us a little bit about yourselves and the research that you conducted.
Sure. Thank you. So I'll start off. My name is Sid Muralidhar. I just recently graduated from Virginia Tech, where I studied finance, and I have experience in the industry ranging from working at a fund of funds, a private equity manager, and even for the Virginia Tech Endowment. And now I'll be working for Citigroup in their sales and trading division come July. So very excited about that. In terms of research, I've been working on this research for the past 5 years, and this was the third paper that I published on the subject of quantifying behavioral biases in investment decisions, and that's where I roped in my father for this third paper.
Well, congratulations on your graduation. Arun, you must be proud.
Very much so, and actually, this award is even more special just because it was done with, my son. And it leveraged the research that he had been doing into topics that are of personal interest, because my background is very different. I used to work for a pension fund, a very large pension fund with the World Bank Pension Fund. I've worked for a large asset management company, JP Morgan, where I was a managing director. And then I've got my own company now, which manages institutional assets. But when I was coming out of school, behavioral finance wasn't a topic that was actively taught. And now more and more, there's a recognition that these topics are of interest. So the fact that Sid was doing this research on behavioral finance gave me an opportunity to dabble in this space as well.
Yeah. So should we start with the RiskStyle method and how you drew your inspiration from Kahneman and Tversky?
Yeah, that'd be perfect. So very simply, the RiskStyle method is a way to quantify individual risk appetite using Kahneman and Tversky's questionnaire from their seminal paper on prospect theory. And so I can just get into, how I came up with it is I was in high school and I attended this school, Thomas Jefferson High School for Science and Technology, where STEM was, heavily the focus. And so I selected the only two humanities courses at the school, psychology and economics, being the rebel that I am. And in both classes, I read about two Israeli psychologists, Daniel Kahneman and Amos Tversky. And these two guys, they dared to dabble in the field of economics as psychologists. And what they did is they challenged the prevailing wisdom that people follow expected utility theory and act in a rational and consistent manner. And so, after they posed this survey of different gambles, for example, 100% chance of winning $3,000 or an 80% chance of winning $4,000, they posed these to a group of students in Israel, and they found that, it wasn't the case that people act in this manner that's consistent. And they found that people have these different behavioral biases depending on whether the bet was framed as a gain or a loss, or even if the bet was altered in terms of the bet sizing or the probability of the bet. So after reading through their paper, I was interested to see my own results and found that I was the exact opposite of their survey group. And so at this point, I wasn't sure if that meant I was crazy or stupid or what. So I posted the survey in my school's Facebook group, and to my surprise, over 350 people responded. And so at that point, I realized I had a rich data set to play with. And so I created a model to quantify the utility functions of each of these individuals. And so this extension of, Kahneman and Tversky's research was my contribution. They'd focused on the behavior of individuals at the aggregate level, and my research, sought to analyze the behavior of individuals and to quantify individual risk biases so that it could be more useful to each of us, in a unique manner. Probably the most exciting part, I think, of the research was once I finished my paper, I sent it to Professor Kahneman, and he kindly replied with extremely encouraging feedback. So that email, is forever framed on my wall.
Yeah, and I think, Bob, Sid raises an interesting point, which is a lot of the economic literature talks in generalities about the population, whereas you and I are individual investors. And for the advisor community, they're dealing sometimes with an individual client as well. So is it true that all these behavioral biases that we're taught about, whether it's loss aversion or endowment effect or consistency, does that apply to everybody, or does it apply to just you, or does it just apply to me? So that's what I think was very fascinating, was we had drilled down into a technique where by answering a few questions, you could potentially have a little report card about what your personal biases were, and you and I could be very different, even though on paper we look very similar in terms of age or kids, et cetera, et cetera.
Right. So for the benefit of folks who may not have read the paper yet, but will after they listen to this podcast, the term risk tile, I mentioned it earlier, but could you talk a little bit about how you came up with that term, that method?
Yeah, sure. So as I mentioned, through high school, that was the process, and the name, I just combined, risk with style, and I said, this is your risk style essentially. So that was kind of the whole process of coming up with risk style.
Right. So let's talk a little bit about the paper itself and why you wrote it and its primary findings.
Perfect. Yeah.
So interestingly enough, this is Arun. When Sid was doing a lot of this research, I was reading these papers, obviously, because it was fascinating. But I don't have a lot of experience in the individual advisor business, because the first two papers were written for magazines that focused on advisors specifically. My experience is more working in groups of decision makers. And the group dynamics are quite fascinating because you could have people with a very broad spectrum of risk biases. And so, I asked Sid, I said, can the technique be applied not just to an individual, but also potentially to a group? Because in many organizations, the decision-making may be driven by multiple people, or even if you're planning, let's say, for advising a family on their investment strategy. Each member of the family could be so unique that when you put the strategy together, how do you make sure that it appeals to the entire family as well? And so the next level of innovation was taking it from an individual analysis to then saying, how can we do this now at a group level? And so that's how this paper evolved, saying, let's examine a couple of groups that make decisions and see if there's something new that we can glean. In terms of the findings, I'll let Sid talk about what were some of the primary findings.
Yeah, sure. So the primary finding, as the title of the paper suggests, is the existence and importance of investment tribes. And so we define an investment tribe as a cluster of individuals who have similar risk preferences. And these tribes can influence how a group makes decisions during periods of good and bad performance. And we can get into that more, but in this current environment, the preference for diversity within investment firms and by external managers hiring those firms is strengthening by the day, and rightfully so. Research shows that the groups that lack diversity fall prey to groupthink. So this was one of the other motivations of this paper, and an interesting way to increase thought diversity in a quantifiable manner is implementing a method like risk tile to measure a firm's current diversity of risk preferences, and then seeing potential additions to the team to increase that diversity. And so as my primary research on individuals showed, you can't assume the risk preferences of an individual based upon their physical characteristics or their backgrounds. For example, you can't assume that a woman investment manager is more risk averse than a male one, even though broadly research shows at the aggregate level it is. but there are plenty of cases of women who are even more risk-seeking than most men. So, it's an important finding that each individual is unique, and to be able to, nail down that individual's unique risk preferences is of utmost importance. My favorite finding, of this whole process is once you go through the analysis and run the numbers, and discussing the results with the people is always the most fascinating concept. And, with this paper, for example, when I'm talking to these investment professionals about, okay, here's what you turned out to be in the terms of, risk seeking to risk averse, they found a lot of consistency with their own behaviors. And some of them, were shocked to think about it because they never cognizantly went through that exercise of saying, oh yeah, that is how I behave. And that's how in meetings, I'm inclined to think. And, seeing their faces light up when they say, oh, wow, that's really interesting, and seeing how it extends to even their daily life, when they speed on the road instead is very interesting. So, all these ways of validating the method.
So at a high level, I mean, you've just hinted at it to a degree, but how does the paper benefit folks within the investment community, and how? What's the actionable advice for folks who after reading this say I should do this or think about this because of what I've just read?
Sure, I'll talk about it from the institutional side, and I'll let Sid talk about it from the advisor side. From an institutional side, if you're managing a pension fund or an endowment, very often you're hiring external managers. And so the people you're delegating to, this paper shows that you may want to make sure that you align with people who have the preferences that you want. Typically, when you do a due diligence process, people fill out an RFP. It's a lot of questions. It's a lot about process. But at the end of the day, you're hiring individuals to manage your money. And so in this delegation to third parties, risk style can be very helpful in saying, here's a firm that has very similar risk tolerances to what I want in this process. So from a group institutional perspective, the delegation process can be made much more efficient because now you know ex ante what their preferences are, and you're not shocked later on when, let's say, there's another repeat of Feb and March 2020, and they behave in a particular manner. Here you're trying to make those preferences upfront, transparent, so that later on there's no hesitancy about why I hired this manager. On the advisor side, Sid, you may have some thoughts as well.
Sure, yeah. And, as you mentioned, the research can benefit the investment community broadly. In terms of the advisor's side, advisors who want to test their clients' risk preferences are able to easily apply this method. And, it goes vice versa. If clients want to test their advisors and see, does this align with my own preferences, or is this an advisor that I want to, choose based on their preferences? That can be done as well. And I guess another application within the advisory community is for, our RIA who wants to look broadly at, the advisors that they have within their team, the diversity and preferences of the team, and seeing where on an aggregate the team lies. It's all helpful information, and Riskstyle essentially provides this, which was not previously, I guess, concretely available in the due diligence process. So, it can also, one other interesting implication broadly for both institutional investors, advisors, and clients is that you can see how people's preferences change over time, given life events, age, education, etc. So there are a lot of applications.
So I do want to talk about the methodology and the specific results, but Arun, I just want to ask a follow-up question to you regarding the hiring of outside managers, some of whom may use or adopt a rules-based approach to managing money where risk preferences may or may not be a factor, or maybe they are and we don't know that. Exactly.
And so, I jokingly say that in every quantitative process, the first input is a qualitative decision. And typically it's a bunch now, except if you use a machine learning or an AI process, which is purely automatic. But when you accept a rules-based process or a methodology, some group of individuals as part of some investment committee must have said yes to it. And so understanding who those people are and what their preferences are could be as important as understanding the process itself. And so there is this fallacy to think that a quantitative process may not benefit from a behavioral analysis because it takes out a lot of the behavioral biases. But when you do test a systematic process and you look at the numbers and you look at the past results, you see, oh, here's a period in which we had a substantial loss. And here's how the model behaved. as an investment committee member, that's where your risk preferences will actually show itself and say, well, can we cut that loss a little bit more? Or that's a loss I'm willing to take. So what we show in this paper that actually it could be applied to either a company that's using a fully systematic process or it's using a fully discretionary process. It could be short-term investments, it could be long-term investments, it could be liquid, it could be illiquid. So the nice thing about this methodology is it applies very broadly to the investment techniques and types of strategies that are out there as well.
All right. So every question and every answer begets another question, Arun. So let me ask one more. Since I serve on a real life investment committee where we're picking small cap managers, real estate managers, international managers for the town's pension plan, we've never approached it from this point of view of using risk style. And I wonder from a practical perspective, how you might use it in terms of saying, okay, I'm going to have a small cap manager and I want them to be risk tolerant, but I want my real estate manager to be risk averse and somehow come to a median level of risk. Is that fair to say?
Absolutely. And that's exactly what the committee members should be doing, is to say, this is what we want out of this manager. Typically, what we've done is we've looked at historical performance and then made the decision entirely based on historical performance. What risk style is trying to do is it's trying to help you see how they might behave in the future when certain events happen. And as we found in this paper, and Sid can talk about it a little bit more, for the illiquid manager, you could see a certain type of risk preference. Whereas for the more short-term liquid manager, there was a very different risk tolerance as well. And that's where you as a committee member can say, this is the kind of alignment I want with people I delegate to. And the same thing could happen with the investment advisor that you hire as well. I want to make sure that my investment advisor understands that I have a preference for insurance contracts because I'm loss averse or something like that. So this can actually have a much better alignment of risk preferences, but also of interests in terms of how the money is managed.
Well, I can clearly see how practical the practical application of this. So let's talk a little bit more about the methodology and go back to the paper about how you conducted the research and why you selected the firms that you did.
Sure, yeah, and I can take that. So, we reached out to a few different investment managers, and for the final paper, we chose the final two for very specific reasons, as my father mentioned earlier. One is a systematic manager focused on liquid assets with a short-term outlook, and the other is a discretionary manager focused on illiquid long-term investments. So this allowed us to compare two distinct firms in terms of a quantitative versus qualitative process, as we were discussing earlier, liquid versus illiquid, and short-term versus long-term investment horizons. And as we've said before, it has broad applications. I've been approached by an RIA, an endowment, and even a pension fund to run the analysis, and we found interesting results there. So for the final paper, we decided these two case studies would be the most interesting to compare for the paper.
And the way the process works is each individual in the team takes the risk style survey. And so what you have is, on the one hand, you have an individual risk report, if you want to call it that. And then depending on how the institutions or the groups make decisions, depending on the hierarchy or the process of investment making, that's where what Sid did is he combined it to say, now what's the group score? So you have both the individual report as well as the group report. And that gives the CIO or the head of the group the ability to drill down and say, I think I'm missing this type of preference in the team that I have. And so while there is a lot of discussion right now with inclusiveness and diversity, as they go to recruit people to increase the diversity of their groups, now you can also say, I'm missing this whole category of risk preference because I've got just one tribe. Everybody is the same. We're all identical. We don't have diversity of thought. And so this can actually help them in how they construct their teams as well.
Right. So talk more about the differences between the individual risk behaviors and the group dynamics.
Yeah, sure. And so I think there are a couple of points, high-level points that really create these differences. And one is it's dependent on each individual within the group. So for the investment tribe, the makeup of that tribe is vital in terms of where that tribe ends on the risk spectrum. Another interesting implication that we teased out in this paper is that for a group, it's, not necessarily a simple aggregate. It depends on how the group makes decisions in terms of the group hierarchy. Is the CIO or CEO calling all the shots, while the analysts, have less of a weight in the decision-making process. And again, since it's a quantitative process, if there is some way to quantify the weight of each member's decision, that can be done as well. And then finally, in the analysis of checking, the group dynamics versus each individual, you can actually see the benefit of diversification. The aggregate will generally and almost always be moderate than any extreme that exists within the teams. And as we've mentioned, this is important in the investment decision-making process when you're facing different and challenging times that require not necessarily one extreme thought of risk-seeking or risk-averse behavior. And having that group diversity helps in making a more moderate decision.
And that's what we found. I think in one of the case studies, it was very clear that the spread of risk tolerance on both gains and losses was very wide. And that's good, because if you're faced with a tough situation and you need to have a decision made, that has the potential to bring all possible alternatives to bear on what the final decision is. Whereas if all the individual risk tolerances are very close to the mean, then what you're likely to have is groupthink. You don't get the diversity of opinion. So what is nice, and it shows up in the charts that we included in the paper, you can see how each individual in the team ranks, and then where the group comes out as well. And if that's a comfortable position for the company, then they can continue to function that way. However, if they'd like to alter the risk preferences of the group, then they have to either think about restructuring the hierarchy a little bit, bringing in new people who provide that alternative perspective as well.
So I think in a way you've answered this, and I suspect I know the answer, but do people behave differently when it comes to gains and losses?
Yeah, and it's a very interesting result that Kahneman and Tversky, they were the first ones to show that, where people tended, from their sample population, people tended to be more risk-seeking when it came to losses, in the sense that they would do anything or risk more to avoid a loss. And that's the term loss aversion that we hear. Whereas on gains, they're much more risk averse, and they'd rather take the sure gain than trying to bet the farm and try and get something bigger. So that was a result that we generally found. But as we've said here time and time again, each individual is so unique that it could be completely different. They could be more risk averse on losses while they're risk seeking on gains, or risk averse on both and risk seeking on both. So typically on aggregate, we've seen that loss aversion, but it varies across the spectrum.
Yeah. It'll be interesting when this gets widely accepted, and we can look at whether aggressive growth managers have a different risk style number than, say, bond managers do, and what that might look like.
How does that change over time as they gather more assets, as they go through a rough patch of performance? All of these little events, and this was Sid's earlier point about longitudinal analysis. Just like you go to your doctor and get your blood tested, let's say every 6 months or every year, and you have a report to compare to in the previous year. The ideal situation with something like Ristyle is you do it now, and then as you have a major event, you update the analysis, because it takes all of 10 minutes to actually answer the questions. And the analysis doesn't take a lot more either. So you can actually have how the company is progressing as well, to make sure that they're still aligned with what you hired them to do initially.
Right. And I suspect finding a correlation between that and the performance of a fund would be somewhat critical.
Right, exactly.
Yeah. So talk a little bit too about, again, back to the study, how many people you studied?
Sure, yeah. So over these past 5 years, when I've been conducting the research, it's come out to over 700 people that I've been able to survey and analyze. And this data set ranges from high schoolers to college students to investment professionals, non-investment professional adults. And now I've started to look at behavioral scientists / people in the behavioral science world. So, it's been a really unique opportunity to go through this process. And, I've had so much encouragement and support over the years, whether it's from my father or, people from the IWI community helping me and supporting me along the way. And so I've got to really, speak with many interesting people on this journey. yourself included, Mr. Powell.
Oh, you're kind to say that, Sid. Thank you. Talk a little bit about the results. When we've talked a lot about applying it to the institutional world, talk a little bit about applying risk style, the method, to the individuals.
Sure. Yeah. So this goes back to my original paper, the first paper that I wrote. And I essentially found that, again, on aggregate, young adult males and females have very similar risk preferences in that they take risks on losses and a risk averse on gains. So as we were talking about, they're basically the same as Kahneman and Tversky's sample population. And that matches up well because Kahneman and Tversky's sample population was Israeli college students. So my research also revealed, I extended it to looking at adults, and I found that there is a behavioral transition in males and females as they age. And so you see that adults over time, they become more risk averse on losses specifically. However, when it comes to gains, males actually become more risk seeking while females become more risk averse. So just interesting implications on at the aggregate level. But again, as I've said, at the end of the day, the most important finding is that every individual is unique in their risk preferences. And while you can categorize people broadly by gender, race, age, education, it might not be an accurate descriptor of their actual behavior. And one thing I did was I looked at, just looking within the investment professional male subgroup, pull out 10 utility functions, plot them, and let's see what it looks like. And it's all over the map. So that's the most interesting implication there.
Yeah, and in fact, in the original paper, what Sid found was he went and interviewed a lady who was 75 years old. And typically in the advisor community, you would be thinking, somebody like that probably is risk averse. They're old, they want to protect, whatever situation they're in. And she came off as just aggressively risk seeking on both gains and losses. And the tell should have been that she had, a little purple patch of coloring in her hair. But it's a classic example of how, if you look at the literature or a lot of stuff that's on the websites of many investment firms, they have a listing of all these behavioral biases. And then there's this assumption that if you're old, if you're a woman, you should be X. And what this reveals is that as an advisor, it probably behooves you to go and look at each client individually and thereby customize your offering to that individual client so that you don't run this mismatch of trying to guess what their preferences are. Here you have some way of actually getting them to tell you how they're likely to behave. And then you can have that discussion and say, here's why I've structured the portfolio in the way in which we've structured it. So for the advisor community, you could actually have a much better dialogue with their clients, existing and prospective as well.
Right. So that may be one of the more shocking results in your research. Sid, are there others?
Yeah, actually, so this is a little sneak peek into my next paper, so I won't give too much away. But shockingly, I've found that those trained in behavioral finance, whether that's through formally studying the topic or practicing it in work, actually have a harder time identifying their own behavioral biases than those with no background. And so, this has very interesting implications for how we teach behavioral awareness in terms of its effectiveness and the way that it's taught. And so I guess you'll have to invite me back once it's all fleshed out.
Happy to do that. Happy to do that. Go ahead, Sid. Go ahead, Arun. Sorry.
Apologize. I was just going to say, I think it goes back to this whole way in which behavioral finance has been taught. It's been more of a qualitative description of these biases, right? When you attend a class or you attend a seminar on one of these topics, or even if you go to the websites of a lot of firms, there's a very qualitative description of what the bias is. And even people who are trained in understanding what Kahneman and Tversky did, or what are behavioral finance concepts, aren't able to recognize their own behaviors when exposed to them. So this could be a nice way for us to start to better understand our biases, not because we're trained in behavioral finance or not trained in behavioral finance, but just because of who we are. And so methodologies like this can actually make that more transparent and hopefully improve the quality of decision making as we go along as well.
Right. So I'm curious, to expand it to look at someone's score on overconfidence, or someone's score on recency bias, or someone's score on, name the behavioral finance bias that we're all susceptible to.
Exactly.
Right.
So in fact, in this paper, by putting a numerical score, Sid and I can be compared very easily. And you can say Sid has got much more risk-seeking behavior when it comes to gains, whereas he's got much less risk-seeking behavior when it comes to losses. And you're able to show which questions they answered in a particular way that actually reveals that preference. So Sid, I think you had a comment about that as well.
Yeah, so I can discuss, how risk tolerance is actually different from other, risk tolerance questionnaires, and it systematically quantifies risk appetite, relying on these quantitative questions rather than qualitative ones that are assigned arbitrary scores that you might find on these other questionnaires. And the point being is that it's stated versus revealed preferences at the end of the day, because as humans, what we say and what we believe about ourselves is not actually how we act or behave in reality. Actions speak louder than words. And so interestingly, Professor Shahar Kareev at UC Berkeley, who's been another mentor and supporter through this journey, is doing a lot of research on this topic. And at the end of the day, it's the crux of our research is that being able to quantify your risk score down to a concrete number rather than guessing based on some arbitrary questions, that's the aim of the game, essentially.
Yeah. So in your opinion, would an advisor use this in addition to a traditional risk tolerance questionnaire or not?
They could. And the point being is, it's in addition to the process, it's something added value to the due diligence process. My bias would be you have this quantitative measure, then you can take the qualitative stuff and you don't have to incorporate it in the score, but it paints a bigger picture and a more complete story than just aimlessly trying to blindly figure that out.
Right. So if a firm or individual wants to go through this analysis, how can they go about doing that?
Yeah, sure. So feel free to contact me at sid.risktyle. That's sid.risktyle@gmail.com. And happy to run the analysis for individuals, RIAs, whatever the team might be.
Right. So before we wrap up, anything that we haven't touched upon that you'd like to make mention of, or anything that you've already mentioned that you would like to reemphasize?
Well, I think the fun part of the research is ideally being able to do this on a longitudinal basis. And then ideally, like you said, be able to examine whether certain types of managers have a certain type of risk preference, and does that correlate highly with performance as well. So if somebody, or if Sid has the time to do that, that could be an interesting question to look at, because here what we're trying to do is make it such that it becomes part of the investment process as well, and not an afterthought. And if it could be done, it'll make behavioral finance a little bit more integrated into the investment process as well. Because today you hear people say, oh, I've got loss aversion and, I've got to worry about all of this. But then how does that actually, work its way into how I design the portfolio for my client if I'm an advisor? This is what we were trying to do with this first step. So it'll be interesting to work with an advisor or group of advisors to say, how can something like this be used to reshape that relationship that you have with the client to make it a little bit more compact, not worry about what the potential risk tolerances are, and guess at them. So would you like to add something to that?
So you mentioned, the longitudinal research being the fun part, and my father won't admit this, but I'd say the fun part of this research was being able to work on this with my father. And it was a really interesting thing to be. I'd been working on this through high school, and then having this collaboration come about, being able to speak at the dinner table, and it definitely helped me get out of a couple of chores. But it's something I'm going to continue to keep working on, and really, really exciting process, and really appreciative of the IWI committee for awarding us the Ed Baker Award.
Yeah, I would be remiss if I failed to mention that you are the first ever father-son team to win the Ed Baker Award. And I'm hoping that this won't be the last of your cooperative efforts to team up and work further either on this research or some other research.
We'll see if my father isn't fed up with me yet. I've already graduated college and I'm being sent off, so we'll see, hopefully.
Bob, the pleasure was mine because it was his idea and I got to piggyback on it. So, there aren't too many dads who can say that they actually had the privilege of getting their kids to do all the work. And so that is definitely.
Well, I'm excited for you both, and I look forward to what's to come next. So, and I want to thank you for being on this podcast. I'm sure our listeners will greatly benefit from you sharing your knowledge and wisdom about your paper.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.